Okay, hello. My name is Michael Grande. I'm a professor at Providence College and teaching the MBA class, MBA 603 at Providence College, Managerial Accounting and Decision Making. And what we're going to do today is we're going to look at a case study. This is a case in Chapter 1 of the Garrison 17th edition textbook, Managerial Accounting. And this is from Chapter 1. This is Case 1-6. And for those of my students, what I would suggest you do before you watch the video, take a few minutes and try to solve the problem, and then come back, look at the video, and let's see how you did. Again, the solution is also loaded up on our learning management system called Sakai. And this is case 1-26, cost classification and cost behavior. So let me read a little bit of it, and then we can get started. The Dorilian Company produces a set of wood patio furniture consisting of a table and 4 chairs. The company has enough customer demand to justify producing its full capacity of 2,000 sets per year. So they're operating at full capacity. That means they can produce no more than 2,000 sets. But they feel demand is strong enough, they'll make them and they'll sell them, so they're going to make all 2,000. And again, we talked a little bit about capacity, we talked about relevant range, and when a company is talking about working at full capacity, the assumption is they can't produce any more than that. Okay, so 2,000, that's the max. Certainly in the real world, there's the ability to make a few more here and there, but in the magical world of academia, we make the assumption when a company's at full capacity, they're at full capacity, and they can make no more than 2,000 units without what? Going to another level of fixed cost. But here their capacity is 2,000 units. Annual cost data at full capacity follow. Well, what are they asking you to do here? Let's go back and read the next page, and under item 1 it says prepare an answer sheet with column headings that break out the cost. Now, they're asking you also to identify some of these costs as variable and fixed. For my worksheet, I only have a certain amount of room here on the whiteboard. We will discuss whether they are variable or fixed. But I'm most interested in breaking down the cost between direct and indirect. Direct costs, direct material, and direct labor, the major components of a product that can be traced directly to the product. And the example we talked about in the PowerPoint presentation, a company that manufactures wood desks, direct materials are the wood and hardware, the major components of my product. I can trace the wood, I can trace the amount of hardware that goes to each particular desk. Direct labor, the wages, salary, and benefits of the employees who assemble, who touch the product, who put together that desk. That is my direct labor. And then the third component, they refer to it as indirect, but it's really manufacturing overhead. And manufacturing overhead consists of 3 big items. Indirect materials, the materials that go into the product, but that we don't keep track of them. They're not traceable. In our example of a company that makes desks, it can be something like stain and nails and paint and varnish. We don't keep track of how many nails go into each one of these desks. So it's indirect materials. Indirect labor in the factory setting are the wages and salaries of the supervisors who oversee the people who assemble the product. We can't trace the supervisor's salary directly to a particular desk. Security, custodial staff, janitorial staff, maintenance staff working in the factory, but we can't trace it to a particular desk. That's the second major component of manufacturing overhead. And then the third component are other factory costs. Other factory costs include things like insurance on the factory, utilities on the factory, property taxes on the factory, depreciation expense on factory equipment. Operative item here being, the key phrase being on factory equipment. So we're going to total up all of our indirect costs, all of our manufacturing overhead, and somehow we need to allocate that cost to each particular desk. And as we get into other chapters, specifically job order costing and activity-based costing, we're going to look at some methodologies on how we allocate manufacturing overhead to the cost of our product. But that's to be seen at a later time. So let's go through these items and let's classify them as either direct or indirect, and try to chat about whether they are variable or fixed. So the first item here is direct labor. Well, that's pretty straightforward, right? Direct labor, that's going to be a variable cost, and that's going to be a direct cost, so that's going to be $118,000. I was going to drop the zeros, but I can't. $118,000 for direct. Advertising cost. Now, that's a fixed cost because it's probably function on a per month basis, so it's going to be a fixed cost, and it's also a selling and administrative expense. It is not a product cost, so we don't even put it here. It's not even on our list of direct or indirect. It's not a manufacturing cost. Factory supervision, well, that's going to be a fixed cost, but it's also indirect, so let's call it factory supervision. And they identified that as being $40,000. That's indirect. It's product cost. Property taxes, factory building. So the key word here is factory. That's going to make it a product cost. But it's not direct, it's indirect. It's one of those components of manufacturing overhead. So we're going to say taxes on the building. And that's $3,500. That's also a fixed cost. Sales commissions of $80,000. That's not a manufacturing cost. That is a selling administrative cost. And it's also a fixed cost. So we're not even going to put it on my chart. Insurance for the factory. Operative word is factory. It's going to be a fixed cost, but it's also going to be one of those other factory costs. That's $2,500. Next item is depreciation, administrative office equipment. It's going to be a fixed cost, but it's also a selling administrative expense. It is not manufacturing overhead. It's not indirect because office, it's not factory. So we're going to ignore that for my schedule. Next item is lease cost, factory equipment. So that's going to be a fixed cost, but it's also going to be manufacturing overhead because it's factory. So it's going to call it lease, and that's factory. Again, key word is factory. That's going to be $12,000. Next item is indirect materials, factory. That's pretty self-explanatory. That's going to be for $6,000. So we're going to call it indirect materials, and that's going to be $6,000. It's going to be my indirect cost, part of manufacturing overhead. Next item is depreciation, factory building. That's the key word there, factory. So we're going to be depreciation, factory. That's going to be a fixed cost. It's also going to be an indirect cost, one of those other factory overhead costs, part of manufacturing overhead for $10,000. Next item is administrative office supplies for billing. Well, it's likely a fixed administrative office supplies, depends on how many bills I have, so that's going to be a variable cost. But it's also a selling administrative expense. It is not manufacturing overhead, so we're going to ignore it for this particular chart. Again, remember, this is my product cost. Pardon me. Next item is administrative office salaries. That's a fixed cost, but it's selling administrative expense. It's not product cost, so I'm going to ignore it. Next item is direct materials. That's pretty clear, isn't it? Direct materials. Product costs. It's going to be direct, $94,000. Direct labor, direct materials, those are direct costs, right? Next item is utilities on the factory. And that's variable because it depends on, how many units they produce probably. It's clearly a product cost because it's on the factory. We'll call it utilities. Factory. And that's going to be $20,000. That's one of those other factory costs associated with manufacturing overhead. So I total up these items. I have direct costs of $212,000. And I've got all my indirect costs. That's going to amount to $94,000. And there you go. So you need to be able to classify these costs as to whether they are direct materials, direct labor, or manufacturing overhead. So that's part one of that problem. Let's look at, let's read part two of the problem. And it's asking us what? It's asking, number two, total the dollar amounts in each of the columns above. Compute the average product cost of one patio chair. So product cost is my direct costs plus my indirect costs. So I have direct costs here of $212,000. I have indirect costs of $94,000. So I've got a total cost of how much? $306,000. And product cost per unit. That's what they're asking you here, cost per unit. We're going to see that again this semester, cost per unit. The cost per unit is going to be total cost divided by the number of units. 2,000, right from the beginning of the problem, they specifically said they were going to produce up to their capacity, and the capacity is 2,000 units. Cost per unit equals $153, right? Cost per unit. Total cost, product cost, total product cost $306 divided by the number of units, 2,000. Cost per unit, $153. Question number 3. It's asking, assume that production drops to only 1,000 sets annually. Would you expect the average cost per set to increase, decrease, or remain the same? Explain. No computations are really necessary, is what they say. So let's understand this here, that we have some fixed costs here, okay? Factory supervision, taxes on the building, insurance on the factory, lease on the factory, okay? Depreciation, utility cost, those are all fixed costs. And remember what we said, fixed cost, total cost stays the same as activity changes. So regardless of the number of units they produce, the total cost stays the same. However, as the number of units goes up, that cost per unit does what? It drops, right? Because you're allocating those fixed costs over a greater number of units. So as the number of units goes up, the cost per unit, the fixed cost per unit goes down. However, as the number of units drops, you're allocating those fixed costs over fewer units. Cost per unit, therefore, should go up, right? And we can see that. Do some quick math, right? $306,000. I don't know if you can see that. I hope you can. Divided by what? 1,000 units equals 306. So if they're only going to produce 1,000 units, then the cost per unit jumps. It doubles, right? It doubles. Because it was 2,000, now it's 1,000. Cost per unit is $306. So the cost per unit goes up. Let's talk about item 4. refer to the original data. The president's brother-in-law has considered making himself a patio set and has priced the necessary materials at a building supply store. The brother-in-law has asked the president if he could purchase a patio set from the company at cost, and the president agreed to let him do so. Would you expect any disagreement between the two men over the price the brother-in-law should pay? Explain. What price does the president probably have in mind? What price does the brother-in-law have in mind? So let's read what the publisher said. He said, yes, the president may expect a minimum price of $153. The president saying that's about my cost to produce it, right? Cost is $153. He might expect the price even higher than this to cover a portion of administrative costs as well, right? Those non-product costs. The brother-in-law is probably thinking of a cost as including only direct materials, or at most direct materials and direct labor. Direct materials alone would only be $47, right? $94,000 divided by 2,000 units, $47 per unit. Or if you add in the direct labor, brings it to 212. 212 divided by the 2,000 units, it'd be $106. So, his brother-in-law, right? What are you going to do? Item 4B. Because the company is operating at full capacity, what cost term used in the chapter might be justification for the president to charge full price, regular price to the brother-in-law and still be selling it? What cost term? Opportunity cost, right? Because if the company is operating at full capacity and selling every one of those units, they're selling them at full price, full margin. For them to take one of those 2,000 units and sell it to the brother-in-law as something at cost or something less than that, they have a lost opportunity. They're losing the opportunity to sell it at a normal selling price. A lost opportunity equals an opportunity cost. So the term they're looking for is opportunity cost. Now, I also added a question, and let me erase this. I added a question number 5 to this problem. And it says, assuming the company desires a gross margin of 65%. Gross margin, gross profit, right? Gross profit percentage, gross margin percentage, the same thing. Calculate the sales price of the patio set. In other words, how does a company establish the sales price of its product? How does a company establish the sales price of its product? The 3 ways. Establish sales price of product. Do they just guess? Do they just say, I want to sell this patio set for, $1,000? How do they come up with the sales price? They just pick a number out of the sky? Well, there's 3 things a company has to know before they establish the sales price of the product. Number 1, cost per unit. What does it cost them per unit to make their product? Number 2, what is the desired gross profit margin, gross profit percentage? And number 3, we would be remiss and not discussing what the competition does. So there's 3 important things a company needs to know before it decides to set a sales price. What is the cost per unit? What is the desired gross profit margin percentage? And what is the competition doing? We know right now that the cost per unit is $153 per unit. And we know that the company's desired gross profit margin is 65%. We don't know what the competition's doing. We're going to talk about that in a few minutes. So again, how do we establish the sales price of our product? There is a formula that we're going to use. Sales price equals cost dollars divided by cost percentage. What is the cost per unit? We know that. $153. What is the cost percentage? Well, let's remember this, right? Let's remember sales revenue minus cost of goods sold equals gross profit. We can do this in dollars and we can do this in percentage. The sales revenue is always the 100% number. If our gross profit margin percentage, our desired gross profit margin is 65%, then what is the cost of goods sold? What is the cost percentage? It has to be what? 35%, right? 100% minus 35% equals 65%. The cost percentage plus the gross profit percentage has to equal 100%. So if I know if my desired gross profit percentage is 65%, my cost percentage is therefore 35%. I'm going to divide that by 0.35. Sales price of our product, $153 divided by 0.35 is $437. That's the price that they should sell it for. Oh, does that work? 437 minus 153 equals what? 284. And if you do the math, you will realize that 284 divided by 437 is 65%. That's how they establish the selling price. What's the cost per unit? What's my desired gross profit margin? And number 3, if we're going to sell this product for $437, what if the competition is selling it for $3.99? What if the competition is selling the exact same product, the exact same table and patio chairs for $3.99? If the competition is selling for $3.99 and we're selling it for $437, what's going to happen? We're going to lose. Everybody shops based on price. Everybody goes up on Amazon and looks for a table and patio chairs and see one company at $437 and another company at $3.99. They're going to buy the one at $3.99 unless they can distinguish it. You know, I'll let my marketing colleagues discuss branding and luxury and all that stuff. But if there are no other distinctions, the company that sells it for $3.99 wins. So this company who wants to sell it at $437 is going to have to make a decision. They're going to have to make a decision. Should they sell it at $437 and maintain their desired gross profit margin of 65%, or do they drop the price so that they can beat the competition? That's a business decision. We talked about the financials. That is Chapter 1, Case Study 1-26. I thought it was a good problem. Thank you.